In this session, I will teach you how to determine fair value less cost of disposal, also known as fair value less cost to sell. How to determine fair value less cost of disposal. Fair value is a common basis of value. I'm sure you have heard of the term fair market value. Fair value is defined as the price that would be received to sell an asset in an orderly transaction between market participants. Hence, fair value less cost of disposal values an asset on the assumption that management intend to sell the asset in an arm's length transaction and thereafter deducting the transaction costs such as the broker fees. Back to our Kraft Heinz example. Let's determine Kraft's fair value less cost of disposal. Step 1. Determine the value a market participant, which is a general buyer in the market, would purchase Kraft for in an arm's length transaction. That is, determine the fair value. Step 2. Determine the disposal costs. This is transaction costs such as broker fees, any transaction fees, any due diligence fees. This is usually around 1% to 3 or 4% of the fair value. And step 3, deduct the disposal costs from the fair value. But how do you actually determine the fair value? Unlike value in use, where we can only use the DCF approach, we can determine fair value in several ways. The most reliable estimate of fair value is the price in a sales agreement, in a binding sales agreement, in an arm's length transaction. But in most cases, you will not have this as you are not actually selling the business. This is all for financial reporting purposes. Then the next best estimate is to use a price from an active market. So for example, the share price from a stock exchange. However, in most cases, this won't exist either. So in practice, we usually estimate fair value using the DCF approach or the market multiples approach. Note, the cost approach or the asset approach cannot be applied for determining fair value. Under fair value basis, when preparing cash flows, we need to put ourselves in the shoes of a market participant. That is, take the perspective of a general buyer in the market. Therefore, we cannot include synergies linked to any specific owner. If you learn one thing from this lesson, it should be this. Fair value is always on a market participant perspective. Now, how is this different to value in use? Under VIU, we took the specific perspective of the owner and we only included the owner-specific synergies in our VIU cash flows. Let me illustrate the difference between market participant perspective and owner-specific through a simple example. Let's look at Amazon's acquisition of Whole Foods supermarkets, which was very synergistic. Synergy 1. Amazon users can order groceries from Whole Foods through Amazon.com and Amazon Echo. This will increase Whole Foods top line, which is their revenue. Synergy number 2, the groceries are then delivered to customers via Amazon Logistics, Amazon's own delivery service at below market rates. This will result in significant cost savings for Whole Foods. And lastly, Synergy 3, Amazon can bring Whole Foods head office under Amazon headquarters. This will result in savings on rental expenses and back office expenses such as systems, accounting, and HR staff. But which synergies are from a market participant perspective and which are owner specific, which are specific to Amazon? Synergies 1 and 2 are owner specific synergies, as these are unique to Amazon. This is because other buyers in the market or general buyers in the market may not have the same online platform as Amazon, and they won't have a logistics services as Amazon, and therefore the general buyer would not be able to benefit from the same synergies that Amazon enjoy. Synergy 3 is the only one that can be claimed by market participants, as the average buyer in the market could combine Whole Foods head office with their existing headquarters and enjoy the cost savings from lower rental and sharing of back office resources. Therefore, cash flow impacts only from Synergy 3 can be included under the fair value basis. However, the VIU includes all synergies. Up until this point, we are still discussing the DCF approach when determining fair value. We have covered step 1, determining future cash flows from a market participant perspective, where we said there should be no synergies linked to any specific buyer. Just a point to note, in practice, we are usually given the business plans, that is the forecast cash flows, by our clients. We need to point out clearly to our clients that if any synergies are included in the cash flows, it needs to be comparable to the expected synergies of an average market participant, and no owner-specific synergies can be included. Step 2, determine the appropriate discount rate. You can refer to our session on WACC for more details on how to derive the discount rate. Step 3, using the discount rate from Step 2, determine the present value of the future cash flows, which were derived in Step 1. Step 4, the DCF approach inherently assumes the value of a business on a non-marketable basis. What does this mean? A fully marketable company is one whose shares are actively traded on a stock exchange. It's easier to buy a public company as we can buy their shares in the open market. But the DCF value is on a non-marketable basis. And when we are deriving fair value, the intention is to sell the business, so it needs to be marketable. So how do we reconcile this? We do this by adjusting the DCF by applying a discount for lack of marketability, also known as DLOM. And the DLOM can range between 10% and 40%. The extent of the discount will depend on how marketable the business is. For example, a business with strong financial performance and good future prospects is more marketable than, say, a business that is loss-making with poor prospects. We cover premiums and discounts in detail in a separate session under business valuation. Another point I want to make here is the DCF approach also assumes the value of a business on a fully controlling basis. And as Kraft in our example is fully controlled by Heinz, a discount for lack of control can be ignored in this case. The other method to determine fair value is the market approach. We cover the market approach under the session on general business valuation. You can refer to that session for more details. But before we move on, I want to clarify premiums and discounts. As mentioned on the previous slide, the DCF approach inherently values a business on a fully controlling and non-marketable basis. As Heinz fully controls Kraft, we ignore the discount for lack of control, also known as DLOC. We can ignore this. Under fair value basis, the intention is to sell the business, so it needs to be marketable. But the DCF is on a non-marketable basis. To reconcile this, we apply a DLOM, discount for lack of marketability. On the other hand, the market approach values a business under a non-controlling basis, but a fully marketable basis. As Heinz fully controls Kraft, we should apply a control premium to reconcile this. Under fair value basis, the intention is to sell the business, so it needs to be marketable. Fortunately, the value derived from the market approach is already on a fully marketable basis, so there is no need for any further discount, therefore no DLOM, no discount for lack of marketability.